I believe there is only one question and one question only that matters for the next several months. And that is uncertainty getting better or getting worse? We have seen some consumer-based numbers, business numbers that are frankly terrible, but getting better. And I think it is because of uncertainty. Taylor, you've been on Wall Street for 12 years. What is going on? What do you think about uncertainty? Is it an important topic? And then finally, is it getting better or worse in the last 5 days?
Yeah, uncertainty is hugely important to the markets, broadly speaking. I think when you look at uncertainty, the biggest gauge or barometer that you could look at is just valuations of the stock market. And uncertainty has gotten remarkably better if you take that as your arbiter as to what the level of uncertainty is.
Yeah, when you think about the market and what you do for a living, again, I'm an outsider pretending to be in your world for a minute. Stocks are always supposed to be kind of a forward-looking indicator, right? What are the earnings of the company over, not really what it's been, but what it's going to be. And then you put on some kind of multiple on that. And if I was going to look at the market today near all-time highs, I would have to say you're right. There is no uncertainty. It's kind of like back to, where we were, pre-Liberation Day. But when I look at the economic data where I'm comfortable living, that's just not true. So how help me out here.
I think there's two functions of valuations. So valuations are a function of price of the stock and the underlying earnings. And you create a price to earnings valuation there. And so most people look at it on a forward basis. So earnings on a forward basis are expected to come in 2025 at 9.7% earnings growth. That's what the street is forecasting right now. I would beg the argument that that might be a little bit optimistic given the backdrop of these multinational CEOs literally having no idea what they're going to be paying for goods. So that's the earnings perspective. And I think that's probably relatively elevated. On the price side of things, that is just for every dollar a company earns, what is the market going to pay for it? And right now, forward price to earnings, assuming that 9.7% earnings growth, is still at an elevated 21.3 times. To give you a little bit of context, average over a 30-year period is just about 16 times. And then historically, we've only had 2 periods of time in the last 30 years where the price to earnings multiple is as high, if not higher than it is right now. The most recent one being in the stimmy check meme stock craze of 2021. Roaring Kitty was firing out there, every stock that you should buy. Or what was this stock? The GameStop, right? That was when everyone was buying that and becoming.
He took down a hedge. Yeah, he took down a hedge fund.
Totally. And the time prior to that was during the 1990s, during the .com blow up. So uncertainty right now, non-existent from both an earnings and a price perspective.
So again, that's, I think I've heard this quote, and I might mess it up, and I'm sure you've heard it. The stock market is not the economy. The economy is not the stock market. Do I have that roughly accurate?
Yeah. And I think that has never been more evident than it is right now. But I would punch a hole through that and say, back out and don't look at things in 3-month increments or month increments or week by week or day by day, which is what the market does. And the market is the economy.
Okay. Well, let's step back, because again, I came out, I think 3 weeks ago and said that I thought uncertainty was getting better day after day. And we had a good string, maybe of 10 days in a row, where it felt like we were incrementally getting to a better place. We were still in a dark place. It was, but the light at the end of the tunnel was getting closer and closer.
Certainly.
And I think it was last Wednesday, it might've been Thursday, when this, federal court, 3 judges ruled tariffs unconstitutional, basically.
Yep.
Then you had all of that rigmarole in 24 hours. Then you had the steel tariffs. Then you had the U.S. saying China's not playing by the ball. And then you have China saying the U.S. is not playing by the ball, or the rules. And it feels like in the last 4 days, we're going in a very bad direction.
Agreed.
Is that fair? Okay.
Yeah. Agreed. Yeah, totally agree. So tariffs right now have just become a perpetual unknown, right? I mean, we didn't do anything with tariffs. We just delayed them. And so now we have these bilateral deals going back and forth between every individual country. It's like, what is going on here? Nobody really knows, right? The thought prevailing in the market right now is that Trump doesn't want to nuke global economic expansion. And so therefore he's going to talk tough, taco trade, like we talked about in the first episode, but then he's going to back off of it when we get some sort of a win. I think the other big unknown out there that is now finally starting to get some news is the budget deal that's being proposed that made it through the House, and now it's going to the Senate, and the implications that come along with that is nothing short of earth-shattering from a debt perspective in the United States.
Yeah, I think that is a big deal. We talked about it a bunch on my daily financial news yesterday, and I think a little bit this morning. That big, beautiful bill, as it currently sits, and again, it could change a lot because it hasn't passed the Senate yet, is going to be adding significant to the debt. And it really starts to feel like the bond market, the bond vigilantes are going to start to scream. Also, I don't know if you saw this, I'm sure you did, but there's a section, I think it's section 899 in the big, beautiful bill, where we are going to tax investors from certain countries an additional 5% up to 20%. That is such an ass backward thing, in my opinion, where we are now. You're basically forcing capital flight. We don't need less money invested in the U.S. when we're trying to, roll over $9 trillion. What the hell are we doing mistreating capital? That just seems like a bad idea.
And that is a very anti-capitalistic view, which with a Republican in office, you wouldn't think that would be the key. I mean, literally, our debt rates are everything. Our debt rates, you look at the 10-year treasury rate, you can essentially say, okay, what is the mortgage? Direct function. What is a mortgage rate? A direct function of the 10-year treasury. What are company borrowing costs? A direct function of the 10-year treasury rate. So as interest rates go higher, which is what will happen if we start taxing things more aggressively from outside investors, all of a sudden it's a deterrent to them buying our treasury bonds, right? And
not only buying, but selling. They're going to be a seller, right? Hey, you're going to, right. We know this. We know that this is what capitalism says. Capital, money goes to where it's treated the best.
Correct.
And if you're going to mistreat this, the people are going to yank their capital and go somewhere else. I mean, just look at the Japanese bond, right? Their 30-year bonds now at 3% or whatever it is really close to ours. This whole yen carry trade could unwind in a freaking heartbeat.
Yep.
And now we're going to mistreat. I mean, it just seems like really, really bad timing.
Yeah. And as rates, that will drive, just to kind of fully round this out a little further, that will drive interest rates higher. As
it has to.
Flight moves, right? So mortgage rates stay elevated, if not go higher. Again, I'm just playing this out, how it theoretically works. And so as interest rates go higher, companies' borrowing costs go higher, reducing their profitability, which should drive stocks downward. It also creates higher competition domestically for stocks as people look at the risk-free rate and say, hey, now I can get 5%. Now I can get 6% risk-free on a U.S. Treasury. Would I rather go out and roll the dice in the stock market and gamble to get more than 5 or 6, or am I good with 5 or 6? So it just creates competition and strife in the market. It makes no logical sense. I totally agree with you.
Well, let's round this conversation out, because I think Warren Buffett is once again telling us something without telling us something. What do I mean by that? It is said that Berkshire Hathaway now owns 5% of the T-bill market, basically the very short front end. And if you don't know, folks, what's going on, the 90-day note currently is paying 4.3%. The 2-year is paying 3.9%, and the 10-year is paying 4.4%. So again, Warren freaking Buffett is saying F the 10-year, F the 2-year. He is throwing his weight and now owns 5%. Dude, he has more of the T-bill market than countries.
Totally.
So what is Warren Buffett telling us by owning such short dated maturities?
Yeah, I think what he looks at is, okay, I need liquidity. All of the treasury curve is liquid. So don't get me wrong. That's no obstacle for him owning longer dated bonds. But what he needs is lack of volatility. And there's so much less volatility on the front end. If he sees an opportunity to go out and pounce on the next Geico or whatever it is that he wants to purchase, he can't have a period of time where all of a sudden his capital is gapped down 5% in 2 weeks because the U.S. proposes this deficit bill, and all of a sudden, boom, you're going to have debt explode, and therefore interest rates pile up, bond prices drop, then he's selling at a 5% discount. He doesn't want to do that. So Warren Buffett does not want to own treasuries, period.
No, exactly.
Period. He wants to be in and out of those things when he finds opportunity, and he can't have the volatility in the price that would come along with being longer on the curve.
Love it. Taylor, where can people find you?
Yeah, find us at LifeGoal Investments, daily videos, Instagram, TikTok, all the socials at LifeGoal Investments.
Folks, go to TikTok, go to Instagram, send them a note, say thank you for coming on ORAT because we appreciate them. Thank you, buddy.
Appreciate you.